and then you put your upper break even on the chart, and you put your lower break even on the chart, your support, your resistance, so you know what possible range the stock could travel in. And as you can see, the upper break even and the lower break even, the upper break even is right on this resistance here where the stock was travelling. So that tells you right away, and it, you know, the support down here and resistance tells you straight away that this stock could easily move within this band here, which is great. You know, that's what you want to see. The ATR is also low. The stochastics has got quite severe bearish divergence. As you can see, this has just been going straight and this has been going down, and the same with the RSI. So you just want to sort of get an idea of where it might go. Yeah, so that's that. And what I've done is a checklist. And this is a simple criteria and the rules that you should follow. So you should make sure you take notice of this checklist, because these are the exact steps I use to enter the trade. So first of all, you want to check, is it low? Is the volatility low? Is it expected to increase? And the way to do that is to check the Bollinger Bands, like I showed you, and you know, check the ATR and see if it's trading in a range, and if there's volume low and things like that. And is there a breakout expected? You know, up or down? You need to check. That's where you check for your technical patterns, your flags, your pennants, double tops, double bottoms, anything like that. You know, are they evident on the chart? You know, is it expected to do something, or is it in consolidation? Are the break-evens for the trade realistic, and are they support and resistance? Because if they are, that's great. You know the stock's going to be able to get there if it's support and resistance. So that is a key component. You know, are the break-evens for the trade realistic? And I suggest you draw them on the chart like I've done. And the last one is the cost to enter below the ATR rule of 2 to 3 times, or just 2.5 times. I mean, the less that you times it by, the more probability it is, I guess, of working it out. But I like to go in between the 2 to 3 and just do 2.5. And if you can, and this is something I do, I even check the theoretical price of the options against the market makers' prices in the system. Like I use E-Trade just to get my live prices, not to actually trade with, but just to get my live prices. I'm a member of E-Trade, and I can always see the market makers' prices in there. But then what I do is I can also go into E-Trade and check out the actual characteristics of the option, and it tells me what the theoretical price is. And if the theoretical price is higher than the market maker's price, then I know that option's cheap. So you know, it's just I guess another just stacking the odds in your favour, so to speak. Which you know, you can never do that too many times. You need to have a few, but you don't want to keep constantly trying to stack the odds in your favour, I suppose. You want to actually be able to make a decision at some point. So, okay, here's the most important part, I suppose, is how to place the order. Now, in broker speak, Strangles are placed as one spread order trade. So you'd be telling them, I want to place a Strangle spread order on whichever stock you want. Now, you've got to check with your broker as to how they place Strangles. They should, I mean, they're all basically the same. I don't think there'd be any difference in between brokers as placing Strangles, because they're just a spread order. But you might want to ask them, if you're not quite sure, I'd like to just tell them I want to place a Strangle, could you walk me through it? And I'm sure they'll be more than happy to walk you through it. So basically I can walk you through it now anyway. So you tell them that based on your worksheet here, you'd like to place a Strangle trade on Suncorp, with a put strike of 588 and a call strike of 612, and ending in May for 2 times, and you want a limit of 53 cents. Okay, so that's pretty much all that you do, really. And you say 53 cents or better. So you say I want a limit of 53 cents or better, because they might be able to get you a cheaper price, which is always good. So just to recap, you say I'm wanting to place a Strangle on Suncorp. I want to buy 2 puts at 588 and buy 2 calls at 612 for a limit of 53 cents or better. May expiry. Alright, Pretty straightforward. Now this would have to be the most important part of the trading process, is monitoring the trade, because without monitoring it, you can really turn a winning position into a losing position very quickly. So if the share price rises or falls to your break-evens or beyond, there are three things you can do. Now I'm wondering if you're sitting there going, oh, so I have to watch the market all the time. Well, you do and you don't. I mean, this is certainly a little more time intensive than like the covered calls or whatever, because you want to be able to make sure you catch those prices when they shoot up. What I've done and what I do is set price alerts. There's a way of doing it through Sydney Morning Herald, I think, and even if you put into Google trade price alerts for Australia or something, you can do it for free. They charge you every time they send you an alert, which is like 55 cents or something, but that's no big deal. And it actually went off just before one of my trade alerts went off that I wouldn't have seen because I was doing this, and had I not seen it, I wouldn't have just made the whole stack of money that I just made. So that's the way to make it so you're not watching the market, all the time. Set yourself some price alerts probably at your or just below your break even, so you know what's going on with the market, and it gives you an alert to check it if you have to. So I would do something like that. Now, the three things you can do nothing, and I don't recommend you do nothing, as it's always good to take money off the table, because time decay plays such a major part here. Because what could happen is, if you don't take the money off the table and you think, oh yeah, it's going to keep going, but then it doesn't, then you've just lost all that profit that you could have made. And the thing is, you don't need to worry about whether this is going to keep going up, because if you take your money off the table and then place another strangle at that level, then you've got your upside or your down and double then downside, protection in place anyway. So you shouldn't have to worry about that. You can sell the calls or the puts. Just sell the call whichever way the market goes. You can just sell them, or you sell the calls or the puts and leave on the other bought option as a free trade. So, if it goes up to your break even and you've made some money, you can just take it off the table and leave the other one open, and without doing anything else. But what that can do though is, if there is still more upside or downside potential, then you lose out on that, because you've only got one option open and you've already closed that profitable one. But this is number 3, is the one I do, and I suggest that you do, is you roll out. So what we do is you sell the profitable option, and you would be selling it for the amount that you actually paid for the whole strangle or more, because that way you've basically paid for the whole thing with just one option, which is the aim of the game. And then you roll the position up or down, depending on whether you sell the put or the call for the profit. So you roll the position up or down for a small profit or debit, because it can happen that when you put it on again, the prices can be a bit more volatile, and you might have to pay a bit more. But it's a small price to pay, because what happens then is you double one side's profit potential. So for example, if the price rockets up and you are able to sell the bought call and you put on another strangle, what you've got then is you've bought another call and you've bought another put, but you've still got the other put that's in place from before. So if the price then turns around and falls, you've got double the downside protection, double the downside profit potential, I should say. So who likes the sound of that? Me.